Welcome back to the deep dive. We're here again to sift through the data, find the real story, and basically give you that shortcut to being genuinely well informed. I'm your host. Today we're jumping into, well, a really fascinating deep dive, the July 2025 rental market. Our guide here is the detailed MLS SAZ Rental Reports July PDF. And just so you know, MLS SAZ is the multiple listing service for Southern Arizona. So we're getting some pretty specific granular stuff. Our mission, like always, cut through the noise, find those key takeaways, and help you understand what's really going on in this slice of the real estate world. Whether you rent, own, or you're just, curious about these market shifts, you should walk away with a much clearer picture. Okay, let's unpack this.
Exactly. And that kind of detailed look is just so crucial right now. You see these general headlines, right? But
Yeah.
they often paint a misleading picture. They lump everything together. But zeroing in on a report like this one, that lets us see the actual shifts, the subtle things happening, maybe even opportunities you'd otherwise miss completely. It's not just reading off numbers. It's about figuring out what they're actually, telling us.
Indeed. And those headlines definitely miss the kind of nuances we're about to dig into. So let's get right into the July 2025 numbers because honestly, they're quite striking. The report pegs the median lease price for July at $1,800. Okay, one data point. But it's when we look at the year-over-year changes, the YOI for July, that the story really starts to emerge. Take the number of leases, it just plummeted, only 138.
Wow.
Yeah, that's a sharp 45.5% decrease compared to last July.
45%. That's huge.
It really is. And the total monthly rental volume, that's down to $254,737. That's a drop of 49.2% year over year. Almost half.
Almost half the volume. Okay.
But wait, it gets, even more complex. Properties are also sitting around longer. The median days on market, DOM, as we call it, went up by 9 days. It's now at 32 days. So it's taking, almost a full month longer on average to get a tenant in there.
Right. More breathing room for renters, potentially.
Exactly. And how competitive are these leases? Well, the average percentage over asking price was actually negative 0.4%, minus 0.4. That's down 0.27% from last year. So what this means for you, renter or owner, is that places are leasing for, on average, a bit less than asked.
So a shift in bargaining power there, definitely.
Definitely. Now, here's where it gets really interesting, maybe even a bit counterintuitive. Despite this massive slowdown everywhere else, activity, volume, DOM, the price per square foot, the dollar per square foot, it actually ticked up slightly. Yeah, from $1.31 to $1.33 per square foot. So
yeah.
How do we square that circle? Doesn't that seem, weird given everything else?
It absolutely does seem counterintuitive when you first hear it, yeah. And that's exactly why we do these deep dives, right? That dramatic slowdown, the fewer leases, much lower volume just in 1 month compared to last year. It immediately makes you ask, okay, what's going on underneath? And the increase in median days on market, that's a very clear signal. For renters, look, this isn't just a number. It means less pressure, maybe more time to look around, and crucially, potentially more leverage when you negotiate. You've got more breathing room. For owners, it's kind of a wake-up call. Maybe you need to rethink pricing or staging or something. Properties just aren't flying off the shelf like they maybe used to. Tenants are taking their time, being more picky. Now, about that small bump in the dollar per square foot amongst all this, it is fascinating. What's fascinating here is it could point to a situation where, okay, demand is lower overall, but the properties that are still leasing, maybe they're slightly nicer ones, higher quality, better locations, the ones that tend to hold their per square foot value a bit better anyway.
Sure.
Or it could just mean that property owners are being kind of stubborn. They're holding their ground on price, not wanting to drop it much, even if fewer people are looking. Like a sticky floor for prices, It's hard to push them down.
That's a really critical angle. But here's what's sort of nagging at me. If things are slowing down so dramatically month over month, is this just like a sudden dip, a blip, or is it part of something bigger, a more settled trend? What do the longer-term figures tell us when we broaden the view beyond just July?
Yeah, that's the million-dollar question, isn't it? And to answer that, we definitely need to zoom out a bit.
Yeah.
When we look at the market activity graph in the report, it tracks the monthly leases and volume over the last 3 years. You can see pretty clear sustained decline leading right up to this July number of 138 leases.
Okay, so not just a blip then.
Doesn't look like it. It's a noticeable downward path from the peaks we saw earlier.
Right.
It suggests these July numbers, while they are stark, they kind of fit into a broader cooling trend that's been developing for a while.
That context is super important. Okay, so let's really nail down that longer-term view. Let's look at the year-to-date stats, the YTD for 2025, and compare them. Number of leases, YTD,
Yeah.
1,355. That's down 12.5% from the previous year, YTD.
Hmm.
And that follows 2,564 leases in 2023 and 2,483 in 2024. So yeah, the decline is definitely there. But here's where the puzzle really gets interesting. The median lease price, YTD, for 2025, it's 1785. That's only down 0.8%. Tiny change.
Almost flat.
Almost flat. It's been remarkably stable, really. It was around 1795 in 23, 1800 in 24, and then the dollar per square foot, YTD, it's at 129. That's the same as 2024, and it's up from like 115 back in 2021, though, yeah, lower than that crazy spike to 171 we saw in 2022. So what does this all mean? How can the volume, the number of leases, drop so much, but the median prices just stay put?
This is exactly what makes analyzing this market so interesting right now.
Yeah.
It's where we have to go beyond just reporting the numbers and really think, if we connect this to the bigger picture, that stability in median prices, even with fewer deals happening, it could suggest a few things. First, maybe it's only the higher priced unit, the really desirable ones, maybe great locations that are still leasing successfully. The demand that is left might be focused right there.
Concentrated demand.
Yeah, concentrated demand at those stable, maybe premium price points. Those properties are often less sensitive to the wider market cooling off. Second, it could mean the overall base price level is just holding strong. Maybe because owners still have high property taxes or high mortgage rates themselves. That sets a kind of floor price they just can't or won't go below.
It's a sticky floor again.
Exactly. Or it could just be hesitation. Maybe renters are waiting, hoping for better deals, or owners are just reluctant to drop prices yet. So for you as a renter, yeah, selection might be getting better, but don't expect huge price drops everywhere. For owners, it's like walking a tightrope. Hold your price and risk it sitting empty longer, or adjust and hopefully get a tenant faster. And about that dollar per square foot trend, holding steady at 129 YTD for 24 and 25, after that 22 spike, that tells us something about how people value the actual space. Yeah. We saw a generally steady climb since 2010, right? So even after a peak and some settling, today's level shows the underlying value of rental space has gone up long term. Even if the market activity is cooler right now, that per square foot cost gives you a clearer picture of value, regardless of the unit size. It shows what people are fundamentally willing to pay for space here.
Okay, so if the big picture is this market kind of in flux, let's zoom back in a bit. What does this actually mean for you if you're out there looking for a place? Or if you're an owner trying to figure out who's renting what and how fierce is the competition? Let's talk renter demand. When we look at leases by price range for July, it's pretty clear where most of the action is. 53 leases, the biggest chunk, were in that very active $1,500 to $1,999 a month range.
The middle ground.
Right. The second most active was $2,000 to $2,499 a month, with 32 leases. Interestingly, way up at the top end, only 6 leases were for $3,000 plus per month. So that gives you a really strong sense of where that sweet spot of affordability and demand is right now. And digging a bit deeper into what people prefer. Leases by number of bedrooms for July shows 3 bedrooms were dominant. 52 leases there, median price $1,850.
Pretty standard family size unit.
Yeah, but 4-bedroom units, though fewer leases at 32, they actually got the highest median price.
Yeah.
$2,195.
Okay, so people needing more space are willing to pay a premium for it.
Seems like it. Now, for the competitive angle, the data by price range table for July, it shows most ranges are seeing places lease for less than the asking price. Like that $2,000 to $2,499 range was negative 0.81% under asking. The popular $1,500 to $1,999 range was negative 0.41%.
Right.
This is super important for renters, suggests it's, a bit of a buyer's market for negotiation.
More leverage.
More leverage, exactly. The only segment showing positive bidding where leases actually went above asking was that $3,000 plus range. They were up 0.45%.
Interesting. Only at the very top.
Only at the very top. Now, beyond just price, how quickly are things moving? That's another key demand signal. So let's look at median days on market for July, broken down by price. The more affordable range, $500 to $99 a month, took the longest, 45 days. And interestingly, the $2,500 to $2,999 range was also slow at 47 days.
Huh. So the very low end and the upper mid are slower.
Yeah, maybe limited supply down low or specific challenges with those upper mid units. Hard to say for sure. But surprisingly, or maybe not, the quickest places to lease were in that $2,000 to $2,499 range. median of just 27 days.
So that segment seems to be a real sweet spot. Good value, good demand.
Looks like it. It's hitting the right balance somehow.
Yeah, this data definitely raises an important question. What does it signal when properties in that mid-range, like the 1500 to 1999 bracket, see the most action, but only the absolute highest end gets bids above asking?
Right.
It suggests that, yeah, there are plenty of renters looking in that middle ground, but they aren't exactly fighting over places. They don't feel pressured to bid up. In fact, like you said, they seem to have negotiating power. But the market for those really premium rentals, it seems to operate differently.
Sure.
There's still a small pool of demand strong enough to push prices slightly above ask, probably for unique places, great locations, special features.
Two different worlds, almost.
Almost. And the difference in days on market across prices backs this up.
Mm.
Why are the 2000 to 24.99 places moving fastest, despite being mid to high price? It could really point to a sweet spot, where the quality meets a price point that a good chunk of renters find acceptable.
Okay.
It's also worth noting the report mentions the median year built for leased properties is 1988, and the average size is about 1,465 square feet.
Right, I saw that.
So that gives us a pretty clear picture of the typical rental people are going for. Not brand new luxury towers, but established homes, decent size. Understanding that profile helps understand who these renters are and what they value. Space, maybe familiarity.
That detail really does help paint the picture. Okay, let's pivot now. Let's look at the other side of the coin, the supply. How many properties are actually available? And this is where we might start seeing some potential future pressure building. Looking at new rental listings for July, the figure is pretty stark. Only 45 new listings hit the market.
45.
45. That is a massive drop, down 295 listings from last July. Wow.
And similarly, new pendings. That's places with a lease agreement pending. They're also way down. Just 23. That's a drop of 73 from last year. So what are the immediate thoughts when you see such a dramatic cut in new inventory coming online? Well, what's fascinating here is how that huge drop in new listings plus fewer pending leases, how that interacts with everything else. Like your first thought might be, oh, fewer properties, scarcity, prices must go up.
Right.
Yeah.
Basic supply and demand.
Basic supply and demand. But as we've just talked about, the median prices are holding steady, and most places are leasing below asking. So that disconnect is a real puzzle. It suggests either the quality or type of supply available just isn't hitting the mark for current demand. Or even with low inventory, renters are just cautious. They're not rushing, maybe because of other economic stuff going on.
So low supply doesn't automatically mean frenzy.
Not always. Apparently not here right now. Now, let's connect this to the active listings now number. The report says 424 properties are currently available. That's the total pool. When you combine that with how fast places are leasing, you get this metric, months of supply now. It's at 3.07 months.
3 months of supply. What does that actually mean for people?
Okay, think of it like this. If no new rentals came onto the market at all, we'd basically run out of places to rent in just over 3 months, given how quickly places are being leased right now.
Okay, got it.
Now, historically, people often say 6 months of supply is like a balanced market, not favoring renters or owners too much. So sitting at just over 3 months, that should signal a really tight market, right? Should favor landlords because things are scarce.
But
The other data we have shows places are taking longer to lease and often going for under asking.
a contradiction again.
Exactly. It's this contradictory signal that points to some underlying weakness in demand. Maybe fewer people are actively looking right now, or the ones who are looking are super selective, or maybe the cost of living in general is making them hesitate. It's a classic case where low supply isn't automatically leading to high prices or bidding wars. Something else is going on with demand. So for owners, yeah, you have less competition from other properties, but you might face more competition for the limited pool of renters who are actually ready and able to sign a lease.
That's such an important distinction. Available supply doesn't automatically mean strong pricing if the demand side isn't quite there. And speaking of distinctions, we absolutely cannot forget that these overall numbers can hide huge differences locally. It's like looking at totally different markets sometimes, isn't it?
Completely.
This report gives us some great regional and zip code data. Quick look at the June 2025 versus last year regional table. The central region had the most leases, 46. But look at the median prices. It's a massive range. The northeast region shows a median lease of just 727. But head over to the upper Northwest region, it jumps to $2,675.
Wow, almost a $2,000 difference.
Huge difference, just potentially miles apart. And we also see some really dramatic year-over-year price changes in specific regions. Green Valley North saw a median lease price jump of $696,
Love 'em.
while the Northeast region dropped by $1,473.
Down significantly.
It just hammers home how hyper-local this market really is. And drilling down even finer. The zip code table. Zip code 85719 had the most leases, 20 of them. But if you wanted the highest median price, or the biggest increase, that was zip code 85750. Median lease there was $3,500. And it saw a massive $1,700 year-over-year median increase.
$1,700 increase in one zip code's median.
Yeah, it just shows the rental market isn't one single thing. It's like a mosaic, right? All of these little micro markets behaving differently.
That's precisely it. And honestly, that might be the single most crucial takeaway for anyone trying to make decisions here. This hyper-local data really underscores that whether you're a renter looking for your next place or you're an owner managing your investment, understanding these zip code level differences, it's absolutely critical.
Can't just look at the average.
The average can be so misleading, it's almost useless sometimes. Different areas just have their own unique supply-demand, price dynamics.
Yeah.
What's happening a few miles away could be a completely different story from the overall trend. So for a renter, knowing which specific neighborhoods are seeing prices soften or DOM lengthen, that tells you where to focus your search for a potentially better deal.
Right.
And for an owner, it means understanding the real competition for your specific property, not just some broad regional number. It really pushes the need for detailed, targeted analysis before you make a move rather than just going off headlines.
Wow, what a deep dive this turned out to be. Okay, let's try and bring it all together. Let's recap the key takeaways from this July 2025 report for you. First, big picture. The overall rental market definitely saw a significant slowdown in activity in July compared to last year. Fewer leases, lower total volume.
Activity down.
Second, despite that slowdown and despite places taking longer to lease, median lease prices, they've stayed remarkably stable over the last few years. Suggests that sticky floor we talked about.
Prices holding firm, mostly.
Third, bargaining power seems to have shifted a bit towards renters.
Yeah.
Most properties are leasing at or slightly below the asking price now. The only exception is way up at the highest end, where there's still some bidding above ask.
Renters have a bit more leverage, except at the very top.
Exactly. And finally, the supply side. The number of new listings coming onto the market dropped dramatically. So we have a low supply situation, technically, even if that low supply isn't uniformly pushing prices way up, probably because of those other demand factors we discussed.
So yeah, given this really interesting mix, right, this significant drop in new listings and overall activity, but prices are kind of staying put, what's the long-term impact going to be? Will that shrinking supply eventually just have to push prices up, maybe as the best available places get snapped up? Or will demand just keep weakening, maybe keeping prices flat or even pushing them down in the next few months if renters stay cautious or face other pressures? As you think about all this, what specific numbers will you watch next? Maybe new pending leases or the average days on market in the specific zip code you care about? What will tell you where this market is truly headed next?